lot of foreign investors, whether it's Japan, whether it's Europe, whether it's other places, especially Asia, but multiple continents. A lot of global capital stuffed into U.S. Markets, especially equity markets. Um, and if you do start to get rate cuts, and you don't get maybe an outright crash, but you just get a softer economy, you get rate cuts, that potentially eases the dollar. And so from a foreign investor standpoint, your returns are not doing very well. You're owning equities priced in dollars, and the dollar's, gone down to at least a moderate degree. You could get foreign equity holders pulling out.
U.S. public debt has reached alarming levels, with deficits running at 6% of GDP even outside of a recession. Lyn Alden warns that we're entering a period of sideways, choppy interest rates, which could push the U.S. economy closer to a downturn. For decades, falling interest rates have been a safety net, but that cushion is disappearing. Lyn suggests that while markets are betting on rate cuts to fuel growth, those cuts might not be enough to prevent a looming recession, especially with rising interest expenses threatening both public and private sectors. The equity markets are overly optimistic, expecting rate cuts and a strong economy to coexist. But Lyn paints a different picture, one where these cuts may come too late to save the market from a significant downturn. If the Fed is forced to expand its balance sheet again, we could see a major shift, including potential capital flight from U.S. equities.
Yeah, basically, I would expect a kind of a gradual rate cut path, unless or until we get some sort of credit event. If a credit event does not materialize of significant scale to start breaking the market in some way, or get unemployment to spike above, say, 4.5%, you'd probably expect mild cuts. If you do start to get some of those events, we could start seeing 50 or 75 basis point cuts at a time. My general base case would be to see a higher low in interest rates. So for about 40 years, we saw lower highs and lower lows of interest rates, both short end and long-term interest rates. And this kind of post-pandemic hiking cycle broke that trend for the first time. We had a higher high in interest rates, both for the short end and the long end. And I think the thing we have to see next going forward, in my base case, is, are we going to get a higher low in interest rates? So they could cut interest rates down to, eventually 2 or 3% for the cycle, but it would still be above the zero that they held it for much of the prior decade. And should that be the case, I would generally expect that the cuts are not going to be as effective for large swaths of the economy as they normally are. And that's because generally when they hit a lower low in interest rates, there's a lot of refinancing activity among existing mortgages.
Okay.
Everybody can basically, kind of refinance their mortgages, and you basically get a free lunch. They just kind of refinance and lock in a long-term lower rate. And if we get a higher low in interest rates, then really the only people that it makes sense for them to refinance are the ones that originated mortgages in the past 2 years or so. And that activity was very low because of how high the rates were. So there's not a lot of refinancing activity if we get a higher low in interest rates. It would be beneficial for small businesses around the margins that generally borrow at shorter durations from banks. It could be potentially beneficial for some marginal, commercial real estate, marginal, banks that lend to commercial real estate. There would be parts of the more cyclical economy that would be, helped by those rate cuts. But the largest part to the economy, kind of the homeowners and the investment grade corporations, a lot of that would be fairly unaffected. So I think that we could be in somewhat of a malaise for several quarters, depending on other factors. And I think that basically the market is probably over-indexing the importance of monetary policy, at least to the extent that we're in a few hundred basis points here. If they cut to zero tomorrow, then of course that would be a massive shock to the market. But
Right.
within kind of their mandate and within this kind of base case of a high or low, I think they're fairly less impactful than maybe most market participants think. I
Like,
mean, I think I wouldn't be surprised if the rates cuts stop anywhere between 2 and 4%. It depends what inflation does. It depends what energy does. It depends on what fiscal policies happen by next year, which is partially dependent on election outcomes.
Sure. Yeah.
So I don't try to predict a specific endpoint for where this happens. There's too many variables into that, other than to say that my base case would be a higher low, which means I'd be rather surprised if we got back to zero rates in the next cycle. I
Okay.
think we're probably going to be elevated compared to that. Yeah, I think we're entering an era of kind of sideways choppy interest rates. And that's a problem because for 40 years, we've had higher public debt to GDP, but we've had structurally lower interest rates. And so interest expense on the public ledger has been very manageable. Same to some extent for the private sector. But as we start to go sideways in interest rates, if we kind of vary between 2 and 6 for the foreseeable future, while public deficits are still running at 6% of GDP outside of a recession, let alone what we would get in a recession. Public debt to GDP is still high and rising. And so interest expense is actually a really serious matter now. So they're kind of constrained on how high they could raise interest rates, especially while maintaining control of their own balance sheet. Basically the slower they are to cut rates, the sooner they might have to go back to expanding their balance sheet because eventually there's so much bonds issued and they would run out of the reverse repo facility, and you get kind of a rejection by forward buyers. I think probably by the end of next year, the Fed's also going to go back to balance sheet increases. Maybe not at a very high pace, but at a positive delta. And I think that's another variable that that'll be kind of next year's story. I think the equity market on average is too optimistic right now. They're basically assuming rate cuts, but also a strong economy, which probably the stronger the economy is, the slower those rate cuts are going to come. In addition, it's kind of assuming that foreign capital does not decide to pull out around the margins, which is to say that right now there's a lot of global capital stuffed into U.S. equity markets. It's not really been like this since around the dot-com bubble. If you look at the MSCI World Index, 71% of it is U.S. equities, and a lot of that is unhedged, which is that a lot of foreign investors, whether it's Japan, whether it's Europe, whether it's other places, especially Asia, but multiple continents, a lot of global capital stuffed into U.S. Markets, especially equity markets. And if you do start to get rate cuts, and you don't get maybe an outright crash, but you just get a softer economy, you get rate cuts, that potentially eases the dollar. And so from a foreign investor standpoint, your returns are not doing very well. You're owning equities priced in dollars and the dollars, gone down to at least a moderate degree. You could get foreign equity holders pulling out from the U.S. markets. And so I'm a little bit less bullish on large cap, expensive U.S. equities. I'm very stock specific or sector specific. I kind of treat each individual stock separately. But for example, everybody right now when they think of U.S. markets, they think of the Magnificent Seven, but I look at stocks like Costco. I mean, Costco is an amazing company, but it's trading at 55 times earnings, right? There's really no margin of safety there. There's kind of a flight to risk off behavior, right? The whole world wants to be in U.S. large cap stocks that are either in tech or that have super stable earnings, like Costco. So there's very little appetite to be in cyclicals. There's very little appetite to be in emerging markets. There's very little appetite to be in commodities. Gold has, even though it's breaking out to all-time highs, there's very little retail interest in it at the moment. It's not really, you don't really see it on most major financial media. You don't really see any sort of mania there. It's kind of like central bank driven and Asian buying driven. You don't really see a lot of retail interest there. And so I do think that we're setting up at least a potential for significant capital rotations out of large cap U.S. low volatility equities and into other parts of the U.S. market, as well as other parts of the global market.
Thanks for watching. Today, we covered Lyn Alden's take on the U.S. economy, from rising public debt to the risks of a recession with sideways, choppy interest rates. While markets hope for rate cuts, Lyn warns they might not be enough to prevent a downturn. If the Fed expands its balance sheet, we could see capital moving out of U.S. equities. If you found this helpful, Be sure to subscribe, like the video, and share your thoughts in the comments below. Don't forget to share this video with others who might find it insightful. See you in the next one.